Lauren Goodwin of New York Life Investments, Chris Harvey of Wells Fargo Securities. Guys, I should also note the NASDAQ on your screen is down more than 4%, right, almost 700 points. We've become more accustomed of late to seeing outsized moves like this, which are so not normal. You're not supposed to get a 4% move intraday on the NASDAQ like we're seeing here. What did you take from Powell? And I think it's undeniable that the market is not feeling good about what it heard.
Yeah, I think that's right. And you really laid out what I think is a critical point, Scott, which is that the Fed's mandates are now moving in opposite directions. And the chair's admission of this and acknowledgement of this is so critical, because what it shows us is really a couple of things that I think the market is digesting. First, if everything's a 50-50, as Steve is describing, then news like this in either direction can whipsaw the market, upside and downside. I think second and critical is that even if the Fed were to step in with a rate cut, what good does that do to clear supply chain tensions? It does very, very little. And third, what the Fed does is becoming more and more divorced with what's happening in market interest rates. So with inflation expectations on edge, certainly near-term inflation expectations de-angered, if the Fed's cutting rates in that environment, then you might still see market rates move higher, like the 10-year yield move higher. That's so challenging for real purchasing decisions in the economy. And so investors are seeing this and saying, wow, if the Fed's stuck, we're stuck too.
Now, Chris Harvey, including the other day, you have been resilient in yourself of sticking with your idea that we could still have a really good return this year in the stock market. And I thought you articulated your views very well, whatever it was, three or so days ago that you were with us. Market doesn't like what it heard from the Fed.
No.
How does this all factor into the way you're thinking today?
So, Scott, what I think you need to do for the next, let's just call it 3 months, market's going to trade in 5-6% increments. It trades up and your portfolio is not doing so well, you need to take risk out. It trades down, your portfolio does well, then put a little bit more risk on.
We need to be that tactical? That's hard for people.
It is hard for people. So if you don't like it, then take the risk out on up days, wait until the second half of the year. I think you're going to have a lot more clarity in the second half of the year on tariffs, on the Fed, and the economy. And what I see is a Fed that's cutting rates next year. And the important thing is, if we go into a slowdown or recession, there's a difference between a recession that's caused by an exogenous shock, which is what we're seeing, and one that's caused by balance sheets that are upside down and backwards, which we are not seeing.
What if it's caused by the hand of one person?
Well, that's the exogenous shock, right? The exogenous shock is we don't know. We don't exactly know what we're handicapping, the degree of tariffs, the timing of tariffs. So markets are rightfully so being a little bit skittish in pricing and risk. The other thing that you're seeing in the bond market is they're pricing in confidence and credibility issues, something we haven't seen in a long time. U.S. is still a very high-quality entity, but now there are questions about how high quality and what premium we should put on that. And so when you wrap all these together, you're still going to get a lot of volatility. If you're an institution, you can't just walk away. What you want to do is protect your portfolio with some sort of low vol, but you also don't want to put your head in the sand. There are still some good risk rewards out there, and you want to slowly start taking advantage of some of these sell-offs, because the secular AI trade is still one of the best secular trades out there.